Well, let's talk about it. Joining us now is Bloomberg stocks reporter Ollie Rennick, Savita Subramaniam, of course, Bank of America, Merrill Lynch's very own, and Mark Okada of Highland Capital, all still with us. Ollie, let's begin with you. Do you just assume that cyclicals are going to start to outperform again?
I mean, I guess it depends on your confidence in the quote-unquote Trump trade, the quote-unquote the rebound in economic growth. I think if you do look at the economic numbers, if you look at what's been coming in, it obviously looks pretty solid. The Fed thinks it looks solid enough to raise interest rates. I think it was a very telling moment when markets got bullish when the Fed started talking about hikes, and we saw the whole team from the Fed come out and talk about interest rates. That was not the norm for several years, and now it is.
An telling moment when you get an upside surprise on something like the ADP report. Treasuries drop, the dollar rises, and equity markets just stay resilient. Savita, when you look at cyclicals, and you've talked of upgrading your forecast because euphoria is about to grip the market, does that mean cyclicals are going to start to outperform again?
I think some cyclicals outperform. So I like financials. I like some of the consumer cyclicals that are pretty beaten down and are still cheap. Other cyclicals I think have run ahead of themselves. Materials is trading on fumes. It's trading on stimulus that may or may not happen within the next couple of years. So I think it's selective cyclicals. But, you know, with the Fed tightening and with the market absorbing it reasonably well, as Ollie pointed out, seems like it's bolster for cyclicals to continue to outperform defensives on the margin.
Savita, when you talk about euphoria, as you did about 30 minutes ago, which pockets of the market do you think investors will become euphoric about, where we will get that melt up?
Well, I would look for areas that haven't really worked for a while. So, you know, here I would point to, again, financials, some of the more cyclical areas within the consumer complex that have really ailed over the last several years. If we get tax cuts, if we get, you know, any sort of move in the rate horizon, that could be bullish for both of those sectors. But I would look for really sectors that haven't worked for a while that could see some upside just from the fact that we're rotating from a falling interest rates deflationary environment into what could be very different.
Yeah, I want to press on financials for a second, because if you look at the price to book to some of these names, though, they're trading right around the levels that we saw, say, even 10 years ago when the 10-year yield was twice as high as it is now. Why the confidence?
Yeah. So I think on the financials, again, you got to be selective. But here's why I have so much confidence in financials. Probably the biggest driver for multiple re-rating is cash return. So we've noticed that as the payout ratio for banks increases, their multiples generally increase. Now, with a less regulatory overhang facing the financials, and with the potential for interest rates to unlock some of that earnings power, I think that there is a longer runway for the banks. I look at it like tech in 2010. It's just come out from its doldrums, and there's a lot more upside for the sector overall.
So, Mark, how does that pair with your world? So if there's upside, we're going to see better yields, we're going to see more growth. How do you translate that into how you invest in credit?
So, we're a user of everything the street puts out there, and we're seeing a lot of activity in the new issue calendar, in the activity of the street. We're also seeing trading starting to pick up too, so secondary markets are working a bit better. So all of those things end up giving you a tighter risk premium, which we're capturing in here, that sort of rise in prices. But I think overall, though, I mean, the trader in me wants to fade this market, the investor in me wants to love it, right? Because it's moved so much, and the trader wants to fade it. But and so we can do that as an active manager. There are parts of this market that have run single names that have run too much, and we'll sell into this rally a bit, and thinking that at some point when the fundamentals do catch up with the name, we'll buy it back cheaper, because that's the dynamic. So. To the point of what happens in the credit market, when it gets very technical on the positive, everything runs with it. We can sell into some of those names that we think have run too much as a trader. But as an investor, again, I really think we should stay long, not sit on cash, and rotate into things that really haven't moved.
Mark, I'm curious, when you talk about getting active and kind of going in and picking those either particular companies or picking the particular credit, this has been an environment a lot of people have waited for to get the kind of dispersion. But so far this year, we've seen money basically going into passive funds. We've seen money avoiding the active managers. What is it about the environment right now that could potentially make this different when it's really been like this for about 3 or 4 months, and stock pickers haven't been doing great?
It's a big setup, right? I mean, we've seen a huge amount of underperformance from active managers, And the way that your normal investor works is they look at their statement. Oh, that's not working, so I'm going to sell that. And they sell at the bottom. So some of this has to come out of the system for this to really start working. But on the other side, you can sit there and look at a trade and say, look, this is all ETF driven, it's way too high, and fade it, right? And then at some point that will start working. And we're seeing that more and more. So the active management activity is starting to pick up. It's not all the way there, but you're starting to see it in the numbers. The numbers from active are getting better versus passive. But it's a big ship to turn. It's going to take a long time for this to really kind of come to fruition. But I think, bottom line, it's a better place to be.
Savita, here's what interests me this morning. If you just looked at the equity market 10 minutes into the session, 8 minutes into the session, you would think there was nothing much going on this morning. The price action is elsewhere. Treasuries are getting battered. For an 8th straight day, yields are up. We're up about 5 basis points on a 10-year, 257. The question we were asking at the back end of last year, I imagine, is going to be asked again and again and again to you in the coming weeks. At what point do we get a backup in Treasury yields that it starts to dent the enthusiasm in equity markets? How far away from that are we?
Yeah, I mean, so here's the thing. There's no magic number on Treasury yields that's bad for stocks. But, I mean, given how low they are today, I think there's a decent margin for upside. I mean, here's the thing. So I think if Treasury yields are moving higher, along with growth, that's great. But if Treasury yields are moving higher and, and the Fed is forced to tighten too quickly because of inflation without growth, that's not great. So those are the barometers that we'd be watching to say, okay, is this a good move or a bad move? And so far, it's been pretty healthy. As you have all pointed out, the economic data has actually come in pretty strong. So I think what we're seeing now is nothing to worry about from an equity standpoint.
But Mark,
at some point we'll worry.
If you take a look at real rates, though, Mark, yes, they had been falling for a while, but they're starting to pick back up. I mean, the 30-year real yield is what, over 1% now. So how can that happen with stocks still up 6 to 8%?
Well, I think she's right. It depends on why rates are up, right? Rates are up because the economy is doing better. So it's the U.S. economy is doing better versus the rest of the world per se, and rates are up. The dollar is up because the U.S. economy is doing better versus the rest of the world. Those are setups that actually are accretive to stocks and valuation. And we have this period where rates are up because money is flooding in from other places. The rest of the world is not doing so well. I mean, we have stagflation, things like that. That's not a good setup. Or the Fed is trying to choke off a too hot economy. We don't have that yet. Now that could be an 18, sort of 19 dynamic, but it certainly isn't right now.
Well, you say